and the existing regulatory frameworks in Europe, and in particular also in the UK, and their replacement in Europe, for example, by the new supervisory authorities, the 3 supervisory authorities, which I'm sure you're familiar with, but their operating methods and remit are not yet totally defined. So that's something we need to keep very, very closely in the front of our minds. We have a long history of involvement in the Russian market and have been actively supporting technical advances for a number of years through our close collaboration with NSMA. And amongst other initiatives, we've worked with NMSA in developing the domestic repo market based on our own experiences in the international repo market, and particularly with the Global Master Repurchase Agreement, which is the most widely used documentation for international repo market transactions. This is currently being updated by an ICMA working group to reflect market changes, and my colleague Lisa Cleary will talk about that in just a few minutes. The association's membership in Russia and CIS has continued to grow during this time. And this has resulted in ICMA launching a new region within our organizational structure, which is based in Moscow and represents the member financial institutions in the region. The creation of a new regional structure, which mirrors the structure we have elsewhere in the world, I may add, is in recognition also of the increased importance of the financial markets in Russia, and also to the initiative of the Russian government. We heard a little bit about that on the previous panel, to make Moscow a financial hub for Russia and the other CIS states. We're constituting a committee of ICMA members from our Russian bank members to drive forward our work in the region and to strengthen support of this well-functioning capital market, although we've heard one or two different views on the previous panel, that's for sure. And we expect to announce the appointments to this committee very shortly. We're engaged in 47 different countries. We have members in 47 different countries. And we've seen our membership growing very steadily in each quarter during this year. And some of that is due to the fact that we're out there talking to members a little bit more often at conferences like this than we were formerly. But a lot of that is down to the fact that members simply realize there is so much going on in the regulatory infrastructure. There's so much information that they need. They know that they can't do it by themselves. In addition, there is an issue, particularly in Europe, that the public sentiment towards the banks at the moment and the financial sector in general is relatively hostile as we've ever seen it. And in that environment, a neutral association representing a broad swathe of members, such as ICMA, is felt to be more useful than perhaps in the good times in the market. But the growing number of members and their eagerness to engage really is indicative of an intense desire amongst these market participants to be fully involved with the challenging process of rebuilding resilient and efficient global markets. I want to spend the next few minutes really talking about the current work streams that we've been operating in over the course of the last year and trying to give you a little bit of a guide as to where we think we'll be spending our time, what our priorities are going to be for 2011. And I want to start with sovereign bonds. It's clear that in particular the Eurozone sovereign bonds are exceptionally dysfunctional. And I don't need to go into the reasons for that. I don't need to explain what it's all about. It's evident. But that is throwing up immense difficulties for our members. And we constructed a sovereign bond working group to address some of the issues and to look at what those issues were. And the issues came into 3 areas. One of them really was transparency and disclosure. And it was very interesting when we went to our working group and we asked some of the senior institutional investors whether they knew in detail what they had bought in terms of some of the sovereign bonds. And some of them were very honest, and they said, well, actually, we've never really looked at these sovereign bonds. We've viewed them very much as a rates product in the past, and therefore we're not aware as to what particular covenants are in these sovereign bonds, whether they include collective action clauses, all of these things which are hot topics these days. And some of them even went so far as to say they weren't even sure what law the actual bonds were constituted under and how they would go against enforcing any rights that they actually had under the documentation. So clearly there's an issue with transparency and disclosure. And the other thing was that there didn't seem to be a great deal of harmonization of the terms and conditions within sovereign bonds, in particular across the space between auctioned bonds, many of which now are held internationally by international investors, and also the syndicated launched bonds. So what we've done is we put out a consultation paper to our members, and it asks questions on these. It makes proposals. It makes a proposal that all sovereign issues that can be bought internationally should have better transparency. That means that there should be a website, and with respect to the simultaneous translation in Russian, we are recommending that for international investors, that website has an English section, and on that English section, you can actually find the terms and conditions of the sovereign bonds, irrespective of whether they've been launched originally through a syndication method or whether they've been auctioned in the first place. So that's one strand of the work. Then we looked at the terms and conditions, and we came up with standard model terms and conditions, which include some of the basic covenant packages that one would expect and have been prevalent anyway in the syndicated part of the market. And we believe that those should be applied across both syndicated and auction debt if that auction debt is being bought actively by international investors. And this is something that we want to consult our members on. And we also recommended, we're not quite sure what the future resolution regimes are going to be in Europe, but we thought it would be wise to have contractual provisions in the bonds which made those bonds more able to facilitate any future reorganization. And we proposed that they included collective action clauses, which we'd already proposed for the syndicated part of the market back in 2004, and also look at the aggregation of those collective action clauses. And these are things that we're working with our members at the moment. We should be, the first deadline for the consultation paper is on Friday, and we will then be discussing this with ministers of finance and DMOs, and ultimately wanting to put forward some recommendations of best practice for sovereign markets as the sovereign markets have changed. Moving on into the primary markets, primary corporate markets, I should say. In the primary corporate markets, they've been very stressed over the last two years since the crisis really started. And we've seen that there are new stresses that weren't there some 4 or 5 years ago. And one of those has been the prevalence of pre-sounding. The other one has been the preponderance of, if it's a good issue, if it's a hot issue, having the books shut very, very quickly. And the other one has been that there have been very huge books generated for relatively modest-sized bonds. There may be a book of 8 to 10 billion euro generated within minutes for a bond which can only grow to, say, $1 billion. And that creates its own stresses in terms of the allocation policies and in terms of transparency of allocation policies. And when we go around to talk to our members, these three things, the three things they tell us, disturb them most in the primary market. So what we've been doing here, and we'll be continuing to do this in 2011, is to bring together the issuers, the intermediaries, in this case the syndicate banks, and also the investors amongst our members, and put them into a room and say, look, there are clearly issues around the primary processes. Why don't you take a look at those and come up with better processes, and then we can incorporate those into our rules and recommendations and guidelines. And we put out an explanatory paper about 3 weeks ago, which details some of the processes that are being used in the primary markets, and we expect to build on that during the course of 2011. In the secondary markets, we're also exceptionally busy, and probably the biggest strand of work that we're looking at the moment is the Market in Financial Instruments Directive, MiFID. MiFID was introduced 3 years ago. It's being reviewed at the moment in 2 levels, level 1 and level 2. It's complicated. It's a very, very all-embracing directive. And we've been involved with CSER. We've put out questionnaires to our members looking at the interplay of transparency, both pre- and post-trade transparency with liquidity. And we are just in the process of starting with other trade associations to respond to a huge consultation paper which was launched last week by the European Commission. And it deals with really everything to do with the securities market. It deals with client segmentation, it deals with best execution, it deals with pre-trade transparency, it deals with post-trade transparency. It's got provisions in there forcing market makers to make firm prices below a certain limit, and code of conduct areas, just to mention a few. And it also touches underwriting, allocation, pre-sounding. So it's clearly a tremendous amount of work for us to undertake with our members on that, and we use our member experts on our various committees to provide a coordinated, consensual response, which needs to be in by February. And then we will be moving on to level 2 of MiFID. So a tremendous amount to do in the secondary markets, and MiFID has the capacity to change the secondary markets dramatically going forward. There's also the debate about moving OTC instruments onto exchanges and central clearing, as we heard about a little bit this morning. Repo is obviously one of the main subjects of this conference, and this has been an incredibly important topic for us over many, many years, ever since 1992, when we created the first GMRA. And we believe that it's become even more important in the post-Lehman's era, and there's increased emphasis by regulators on secured lending. And you may have noticed that our ICMA European Repo Council, and you'll be hearing tomorrow from Gottfried de Witz, who's the chairman of that particular council, released a white paper on the European repo market a few months ago in the early summer. And it highlighted the role of short selling, which is clearly an important component of why repo is needed, the problems of settlement failures, and importantly, the need for reform of market infrastructure, whilst also emphasizing the importance of the repo market for the overall efficiency and stability of the financial system. And we really believe in repo. We think it's one of the most important topics that we cover. And at ICMA, we spend probably more of our resources on the repo market than we do on any other single segment of the market. And the paper was really in response to the current regulatory considerations which are impacting the repo market. And there's concern that the initiatives shouldn't constrain the capacity of repo in Europe at a time when increasing demands are being made on it, both by the regulators themselves, in terms of proposals for enhanced collateral management, for example, and also, importantly, indirectly, by the governments in terms of increased debt issuance. There's clearly an urgent need to improve the efficiency of the international repo market. And what that means is we need action in removing the remaining barriers to the efficient cross-border transfer of securities posed by the current settlement infrastructure. And this paper highlighted some of those deficiencies, certainly was very well read by the jurisdictions where those deficiencies are, because we get a lot of calls about it, not all of them particularly positive to us, but I think it created a lot of noise, which is a very good thing. And it suggests solutions, and it's certainly been the substance of ongoing discussions with the providers of market infrastructure in the various different jurisdictions within Europe where there are interoperability issues. I think we're making very good progress in resolving some of these matters, and this white paper certainly kick-started a little bit of movement in certain of the jurisdictions, and we're very pleased about that. We have seen progress, we continue to see progress, and we're going to be publishing an annex to the white paper either later in December, it's getting a little bit late now, or perhaps very early in the new year. Talking in particular about two of the jurisdictions where there's been good progress, and we're going to be using that to update our members. I think probably I'll leave it there. there are many, many other things we're doing on the asset side in terms of valuation of assets, the transparency of valuation models, in terms of looking at a code of conduct for private banks, etc., etc. But I think the overriding message is that some absolutely key themes out there. We're extremely busy. We have been extremely busy all year, and we expect the pace of our activity to continue to grow during 2011. Again, many thanks to NSMA. It's really a delight to be here. I'm looking forward to meeting many of you over the course of the next couple of days and fielding any questions that you may have. We very much value our cooperation with the NSMA. We like to try to overlay the international piece into the domestic markets, and I wish you all an excellent conference, and I'm looking forward to being with you as much as possible. Thank you.
Maria, and thank you very much for being here. I'll try to be brief. I thought I had more time than for 20 minutes, so Maria, you need to be my watchkeeper in case I overrun. So very quickly, where do we stand after the crisis? Or what was the impact of the crisis? The major impact was basically total dry up of the unsecured money market. To a very large extent, dry up of the term funding as well. All of that moving towards central bank financing. The crisis was such that central banks had to intervene massively. Now, what is coming next? We believe that, talking to our clients, the unsecured money market is gone, to a large extent. We start to see term funding coming back. A term, we don't talk about very long term, still we are within the 30 days period. We do see structured trades for much longer transactions, but more for very specific transactions. We see certainly a need and a demand for the development of a CCP. I think LCH has a product, Eurex has a product, and I guess my colleague from Classroom will be able to speak about it much better than I could. And then the big question is, when will the flow from the central bank move back to the market? Because today, the central banks are still very much there. I would say that probably 6-7 months ago, I would have anticipated that the central bank would start to push back the financings towards the interbank market, given the issues we face in Europe with Greece, Ireland, and who knows next. We really don't know what will happen. So that's a big question mark for us. Next to that, we have our regulators that are trying to take care of what the future will be. I mentioned Basel, the European Commission. There are others, and this may be an issue. Regulation as such is not really bad. The problem is that when you have more than one regulator, they're not necessarily coming up with the same idea. That's a serious challenge for all of us. If you look at Basel II, Basel III, what they say is a liquidity ratio. You need to be able to cover with liquid assets at least 30 days of cash outflow. Okay? So it's cash outflow, we don't talk net. So it can be a pretty significant amount. What the Commission says is that you need to be able to have a stable funding. What the definition of a stable funding is, I don't know, maybe others do, but it varies. In the UK, for instance, they're talking about 3 months, but other regulators might have a different view. So how are we all going to be able to manage all of that? What is clear is that if, and if is important, you can use those assets that you need to keep on balance sheet, then it will lead towards more term repo. More term repo, what does it mean? It means that you need to become more efficient. I think one of the crisis lesson is that I think infrastructure went through it fairly well, but some of the banking sectors were probably a bit too aggressive in the way they were doing business. They were having collateral, but not checking it very regularly. They had a price, but didn't really look at when the price was dated from. They thought they would be able to sell the securities. All of that has realized, they all have realized that dream and reality can be different, certainly when you go deep into a crisis. So we think that this will lead to changes because people will need to change the way they work. The ECB will change rules, regulations will come, and we believe that a certain number of products can help, and one of them is tri-party. Tri-party is basically a product whereby you outsource to a third party, which is independent from the trade, the management of your collateral. When you take collateral, you basically move away from counterparty risk, but you create some liquidity risk, some corporation risk, some market risks. What's the liquidity risk? Two elements. Is the capacity that you have to finance this collateral that you've received. In terms of prices, you may want to reuse the collateral that you've received in the repo. Today, it exists, it works, but to a fairly limited extent. The other risk, in terms of liquidity, is that you need to be able to sell your assets the day you need to. And then you have a market risk with appropriate haircuts. What we've seen today is that everybody has a different view as to what the market is, what the haircut should be, what the risks are. What is key? Before a default, basically, you have taken collateral with a margin, more or less important, depending on the risk that you see on the paper that you take, and also the risk that you see on your counterparty. And all of that goes fine. Normally, you are over-collateralized. Then happens the bankruptcy, and the Lehman case is a good example. What happens? First, you need to be able to quickly recover your assets. You need to have a system to do that. And two, you need to be able to act very quickly in order to be able to sell those assets. If the market keeps going as it passed, then you have no issue. If the market dries up, as we've seen 2 years ago, then you might be in serious trouble because the assets that you had, the haircut was absorbed, I would say, within 2-3 days. And those of you who didn't manage to sell their collateral within a week or so were probably starting to face a potential loss. So all of that is something extremely important and has obviously received a lot of focus. So we'll skip that. Tri-party basically is a summary. You appoint an agent. There are 4 main tri-party agents in Europe. It's Clearstream, Euroclear, Bank of New York, and JP Morgan. And basically you agree on the set of criteria with your counterparties. Which kind of collateral do you want? What's the concentration limit that you take on that? What's the type of pricing that you're willing to take? What's the age of the pricing that you're willing to maintain, etc., etc. We put all of that in a computer, and the system does the management for you. What is key, is, as I mentioned, is reuse of assets. So what we call rehypothecation. Today, the reuse of assets is fairly limited. Why is it limited? Because the agreement that counterparties have with one another are different. I.e., they don't take the same kind of collateral, they don't have the same haircuts. Meaning that when you want to reuse that collateral that you've received with somebody else, maybe that somebody else has a different view than you, and therefore it makes rehypothecation extremely difficult. So what we need is to move towards more baskets, standardized baskets, so that everybody agrees on those baskets. It's very, very good that several people mentioned the willingness to move to baskets and to CCP, because that's probably what is really needed for the market to further grow in a very risky type of environment. What you need to do as well is try to simplify as much as you can the documentation. So a basket is one thing, but you can still agree with your counterparties on very specific needs that you might have. Okay? So that you're not forced to go into one. So the idea of what a tri-party agent needs to provide is flexibility. Okay? We need to be able to find a solution for you. We need to be able to work with you, because trades that you will do can be a normal transaction, but they can be a very specific trade for quite long term, And if it's long term, you want to make sure that your risk is appropriately managed. Operational risk, I will probably skip. This tells you that facts should not be used anymore in this environment. We should move towards STP. And then one important thing is that once you move towards term repo, you need to have the ability to substitute collateral, because those that have given you securities may want to sell them, and if they can't sell them immediately, they will just walk away from the trade. So having a system that allows for easy and quick substitution of collateral is fairly important. What we need to push as well is harmonization. You have the normal repo, you have securities lending, you have OTC derivatives, and you have central bank credit operation. All of those require collateral. The more standardized we can have in terms of process and in terms of documentation, the better it will be for all of us. What's next? I think it was mentioned in the previous speech that there is an issue today. It's the interoperability across the different markets in Europe. If you go to a trader, they have their assets within one of the two ICSDs, and it works fairly well. Now they probably have Spanish bonos, Italian govies, Portuguese debt, Greek debt. This might be with the ICSD as well, but they may do most of their activity domestically. Some of their counterparties wants to use a tri-party agent, therefore they need to move the position, basically depot manage their position in a specific instrument. What we need to do is to find a way in order to have access to those positions that are available not in the ICSD, but in the domestic market. That is something that the market is working on. And that will allow interbank market rate, markets to function, the CCP market to better function. The CCP will be able to get securities coming from abroad as well, without the market participant having to manage those realignments themselves. Where is the market going? That's obviously the European view. This is an end of, I think it's end of October, I think we're above 300 billion outstanding today. What's interesting is to see that our curve is following pretty much the curve from the ICMA. What you notice as well is that tri-party repo, assuming interest rate is about the same number as we do, still a lot of room to grow from the bilateral repo towards the tri-party repo. That slide is quite interesting because it really shows the flight to quality. If you look in December 2006, about 20% of the collateral was BBB or below. Today, it's hardly 5%. Okay? Now, the issue is, if the government bonds are not AAA anymore, if a lot of the corporate debt that was structured financed in the past are losing their AAA as well, where do we go? I don't have the answer. This gives you an update in terms of maturity, and as you see, about 50% of the trades still are within the 1 week. We see, as I mentioned earlier, trends towards longer-term finance, but this is not yet a real practice. And that's it for me. I'm happy to take any questions.
Thank you.
Maybe a bit rushed, but...
No, it's okay. If someone, any questions to Philippe, to his presentation? If there are no questions, we'll have a pleasure maybe later, so at the end of the panel.
Thank you very much.
And in 2010, for the 10th consecutive year, according to Custodian Tripartite Securities Financing Survey, Christian was top-rated. Gert is working as a senior project manager in client relations, global securities financing broker-dealers, and he joined Christian. It was a Deutsche Kassenverein, and now it's Christian Franklin in '96. So, and he participated in a lot of projects, and among them a joint project with Deutsche Bundesbank, where Gert has developed.
Thank you, Maria, for the introduction. Thank you for being here. It's a pleasure for me. First time I attend this conference, and maybe it's not going to be the last time. The topic, global liquidity management, is a very broad topic. So obviously within the next 15 minutes, as I promised, I cannot cover everything, but at the end of the presentation, I will give you some idea on, at least you can dig further into the topic, but I keep that surprise for the end of the presentation. So what I've done is I've structured my presentation in 3 parts. Quickly, lessons learned. I think a lot of the things that Philip said will be repeated, and I will keep it short. Secondly, I would like to talk about the GC pooling market, one of the markets that really has grown during the crisis, and that shows how the markets have changed. And last but not least, I'd like to give a couple of outlooks similar as for the most. So lessons learned. I think it's very clear this is mainly about trust. Trust has not come back to the markets. The unsecured money market, for example, has completely dried up. People have developed a different consciousness regarding the eligibility profiles, the collateral types that they accept. So this is the environment within which we live and will continue to live. Secondly, central banks have become very important, and still they are very important. And we're all looking for the exit, but no one can tell us when this will happen. And thirdly, this is the whole regulation topic that's coming up. So this will completely change the environment for the participants, starting with Basel III, the liquidity measures, but also one interesting trend is the push into CCPs, because CCPs, again, will require a lot of collateral from participants. And this is the general trend that we observe, that participants are more and more required to efficiently manage the assets they have available in the first place. And this has brought structural changes to our customers, and this structural change comes back to us as different requirements that we would need to fulfill as service providers. Now, what I'd like to show to you is the development of our collateral management program, the Global Securities Outstanding Volumes. You can see we are now up to 550 billion that we manage on a daily basis. And what is interesting and I believe encouraging is that even though we had a crisis, the level of collateralization seems to increase. So this is the first thing. But if you look in the detail, the structure has changed dramatically, because you can see how that overall line is composed into 2 sublines. And the dark blue one, which was the leading line at the beginning, represents kind of more the bilateral tri-party style of business between counterparties. And you can see what happened to that line during the crisis, because there was a lack of trust, because eligibility criteria had changed, because the environment was different. But there was another line which catched up and took over at a certain point, and this is more the standardized products involving a CCP, as Philip has already pointed out, standardized products and access to central bank money, and this is now the leading line in our business. Looking at it from a trading point of view, here's statistics from Eurex Repo. We are running that market as a trading venue. You can clearly also see that the standardized product, GC pooling, which I'm going to talk about in a second, has taken a complete dominance in the meantime, and it's continuing to grow. Again, last week and this week, there have been new record highs in the product. Now, what is this product about? And I just jumped already to this picture because that gives a very good explanation how it works. This is where repo takes a different nature as opposed to the portfolio financing that we very often see in tripartite. This is a cash-driven repo against a standardized basket. So people trade, and at the point of time of trading the cash, so either they raise cash or they place cash, they don't know which kind of security they're going to receive at the end of the day. However, what they know, they're getting a certain quality. What was very important for the product was that this is a high quality, what we call the classic basket. So out of the universe of 50,000 ECB eligible assets, we end up with 8,000 very high quality paper that we accept in the basket. Now, this goes through a trading platform into the CCP and then into the tri-party and collateral management environment. And the important features during the crisis have been A, anonymity. This is absolute anonymous trading. No one wanted to be seen in the market as looking for cash or placing cash in large amounts. So anonymity was key. So once the trade is concluded, it immediately goes to the CCP, who steps in. Secondly, CCPs are traded favorably by regulators. So there is a zero risk weighting on the CCP trades because the CCP has a very strict risk management. And then, only on the level of the collateral system, the allocation of the assets is done. So trading platform and CCP don't know about the underlying assets. It's only the collateral management systems that will then, according to the standard, allocate the collateral to the trade. And here comes another very important feature, and this is something which is, I believe, especially interesting also for the central bank in the debate about access strategy, because the assets that a cash provider would receive in such transaction can real-time be reused to the central bank. So what is achieved through that is a closing of the loop. Why? People were afraid to give out cash. Now here they have a tool. They can give out cash, they receive collateral, and immediately they can have central bank money funds against it, because they can reuse it for intraday credit or using it in monetary policy operations. And this has been